Hey, thank you for joining in again today. I really appreciate it. Hopefully you guys had a good holiday. Today we're going to be talking about buy-sell agreement, or sometimes also referred to as a shareholders agreement. So these are the couple of things that you need to understand about a shareholders agreement. When you are going to go get a shareholders agreement, you have to go to a lawyer. So make sure you talk to a professional before doing anything. So first thing on a shareholders agreement, you got to decide on the structure of your corporation and the structure of that shareholders agreement. Now the second thing is that who owns the shares? Do you own the shares? Does your partners own the shares? And the amount of shares that's in the company itself. Now the ownership, you have to decide on what happens when a buyout happens. Let's say one of the shareholders wants to leave. And do we have a shotgun clause, or do we voluntarily let him leave and we have a certain stipulation that he has to abide to afterwards? Maybe you might want to include a right of first refusal on your shareholders agreement. So if he goes and finds another buyer that you don't approve of, you can actually buy the shares from him or her as well. So what happens if one of the shareholders gets disabled or actually passes away? You should have a clause in there for disability. I've seen some clauses in some shareholders agreements that, if the partner is disabled for 3 months, all of a sudden it triggers a buy agreement, and that doesn't make any sense. So usually, the normal course, we usually see about a year or 2 years, because you can't keep supporting the person that's disabled, because there's a couple of things that come into effect. Is that they're not contributing into the company and they're still getting paid for the company too as well. So there is a way to mitigate this too as well, is that you can also purchase disability insurance on that person. So that therefore after a year, the payments would start and the shares can be transferred over to the person that is still running the company. Now what happens if a shareholder passes away? That's another instance. Now, do you know what happens to the shares if you don't have an agreement in place? So the shares will actually get transferred to the spouse, or they can actually get transferred to the kids. Now, do you want the spouse to be involved in your business? Do you want them to have say in it? Or do you want the kids to have say in it? They could actually destroy it. So you have to realize is that you have to have some sort of agreement in place. Now, I'm going to give you an example. I'm going to show it to you on the side. There's going to be person A and person B. So you're going to notice they both have 50% shares in each. Now, if you're going to be funding this, and you can fund it with life insurance too as well. Now, if you fund it with life insurance, you're going to actually save a lot of money on the buy-sell agreement. So what ends up happening is that if a person passes away and you don't have insurance into effect, the person that has to purchase those shares, so let's say it is person B that's purchasing those shares. Let's say the shares are worth $1 million. Now he has to come up with about $1.9 million worth of after-tax dollars. So when we do an insurance buy-sell agreement, what we do is we would purchase $1 million worth of insurance, and then when a person passes away, this amount would pay for the shares. And then the shares can be owned by person B or person A, whatever case it may be. So it's a much simpler way to do it, a much cost-efficient way to do it than you not having a shareholders agreement and not having it funded by insurance. So let's look at A and B again. So in the first one, A and B, they both own 50% of the shares. If A passes away and B is surviving, then B can go ahead and purchase those shares from A, and now he owns 100% of the company, or she owns 100% of the company. So just realize is that this is a more efficient way to do it too as well. Now, the one thing that you have to realize is that you have to determine the value of the shares. Now, the value of the shares is not going to be determined just by you making an arbitrary amount. You're either going to have to go to an evaluator, or you're going to have some sort of formula, because CRA is looking more and more into that because of the wealth transfers that are occurring. So the other things you should not assume when you're doing a shareholders agreement is that everyone is going to agree. That's one thing that everyone does as a mistake. Not everyone will agree. Now the other thing is that you have to make sure everyone's objectives are met and their visions are also met too as well. Now you have to ask yourself, what is the downside of this agreement that you're making too as well? And don't forget that. And lastly, get advice from your accountant, because this is going to make a big tax consequence too in the end if you don't do it the right way. I've seen partnerships happen, and I'll give you an example, and this is a common case that you'll always see out there. You got 3 partners, each one of them owns shares. One of them passes away and the spouse takes over. And when the spouse takes over, the spouse wants actually more say into the company. And maybe the other partners don't want that. So with one instance, these partners had to declare bankruptcy and start all over again. Lots of cost to that. And the way to prevent that is a shareholders agreement. I really appreciate you guys joining in again today. Hopefully you got some good information out of this. If you know anybody that needs some help in buy-sell agreements, please pass this video along. And don't forget to subscribe, hit the little bell at the bottom so you get my notifications too as well, and like the video. I really appreciate it. Take care. See you next time.